If you're starting with just $100, the first thing you need to understand is that investing is not about how much you start with, but how consistently you grow that amount. The mistake most beginners make is thinking they need thousands to begin, but the truth is $100 is more than enough to take your first step. The key lies in choosing the right strategy and avoiding emotional decisions. First, let's talk about mindset, because without the right mindset, your $100 won't last. Your money should be treated like a seed. If you plant it in the right soil, water it with knowledge, and give it time to grow, you can watch it become a forest. The soil, in this case, is your strategy and knowledge, and the water is your discipline and patience. Too many people burn through their first 100 chasing quick wins instead of building a foundation, and that's where we start with step 1, understanding what type of investor you want to be, passive or active. Passive investors prefer to set their money and forget it. Active investors want to watch the market and make moves every day. Neither is wrong, but you must know which one you are. For beginners, passive investing is often safer and easier. One of the best places to start is with exchange-traded funds, also known as ETFs. ETFs are collections of stocks or bonds you can invest in all at once. They give you instant diversification, which reduces risk. For example, buying an ETF like the S&P 500 means you're investing in 500 of the biggest companies in the US. Instead of picking one stock and hoping it wins, you're spreading your bet. This is one of the smartest ways to begin, and yes, you can start investing in ETFs with just $100. Many platforms today like Fidelity, Charles Schwab, or apps like Robinhood and Web will allow you to buy fractional shares. That means even if one share costs $400, you can still invest just $5 into it and own a fraction. The key is consistency. If you put in $100 once, that's a good start, but if you can add $20 per month, now you're building real momentum. Let's talk about step 2, choosing your platform. Beginners often get overwhelmed by choices, but your platform should have zero commission trades, allow fractional investing, and offer a user-friendly interface. Do not waste your $100 on fees or complicated platforms. Pick one that suits your style and stick with it. Now let's explore another key principle: time in the market beats timing the market. Many people try to guess the best day to buy or sell, but studies show those who stay invested consistently outperform the ones who jump in and out trying to be clever. Your job is not to outsmart Wall Street. Your job is to be patient and disciplined. Compound interest works only if you let time do its thing, so whatever you buy it for the long haul. Now let's imagine you've picked a low-cost ETF, you've put in your $100, and you're adding a little every month. What's next? Education. The best investment you can make is in your own knowledge. Read books like The Intelligent Investor by Benjamin Graham or watch free YouTube videos that break down investing concepts. Follow reputable finance creators, not hype channels that promote get-rich-quick schemes. And when you feel ready, you can explore stocks, mutual funds, REITs, crypto, or even real estate, but all with the same rule: never invest in something you don't understand. Remember Warren Buffett's rule number 1, never lose money, and rule number 2, never forget rule number 1. Your $100 is a start, not a lottery ticket. Don't treat it like a gamble. Treat it like a business, and as your knowledge grows, your portfolio grows. Now let's talk about risk. $100 should not go into a single meme stock or trendy crypto coin. That's speculation, not investing. Avoid hype, avoid panic. Buy what makes sense, even if it's boring. Boring makes money. Now what if you lose money? That's the next part. Every investor loses at some point. It's part of the process. Your job is to minimize the loss and maximize the lesson. If your investment drops by 10%, don't panic. Instead, ask yourself why. Was it bad timing, bad choice, or just market noise? Learning from your first 100 builds habits for your first 1,000 and your first 10,000. This is how you grow slowly and wisely. Remember, building wealth is not a sprint, it's a marathon, and your $100 is the starting line. In part 2, we'll talk about diversification, dollar cost averaging, dividend investing, and how to emotionally stay in the game when things get rough. Now that you've taken your first step and planted that $100 seed, it's time to think like a gardener, not a gambler. You don't just water one plant and ignore the rest, you diversify your garden. The same applies to your investments. Diversification is your safety net. If one asset falls, another might rise. That's why in investing, you never put all your eggs in one basket. Let's break this down. If your entire 100 is in one company stock and that company crashes, you lose everything. But if you split your 100 into 4 pieces and place them into different assets like ETFs, individual stocks, REITs, or even crypto, you reduce your risk. Some might dip, some might soar, but overall your portfolio stays healthy. Now imagine over time you continue adding more and more to each category. That's how wealth gets built quietly and steadily. The next strategy is dollar cost averaging. This means you invest the same amount at regular intervals regardless of market conditions. For example, if you put $25 every week into the same ETF, sometimes you'll buy when it's high, sometimes when it's low, but over time you'll average out the price. This removes the emotion and guesswork from investing and turns it into a disciplined habit. And that discipline is what separates rich investors from broke speculators. You're not trying to time the market, you're building a machine that grows with time and discipline. Now let's discuss dividend investing. Some companies share a portion of their profits with shareholders through dividends. If you own a stock that pays dividends, you receive a small payment regularly just for holding the stock. Imagine owning a piece of a company and getting paid quarterly for doing nothing. That's passive income in its purest form, and when you reinvest those dividends back into more shares, your wealth begins to compound at a faster rate. There are entire portfolios built around dividend aristocrats, companies that have raised dividends for over 25 consecutive years. These are often stable, well-managed businesses that reward long-term investors. And yes, you can buy fractional shares of dividend-paying stocks too, even with your $100 start. Now on to emotional intelligence. This might be the most overlooked but important part of investing, because when the market dips, most people panic. They sell low, buy high, and repeat the cycle of loss. But not you, because you'll train your mind to see dips as discounts, not disasters. The stock market is the only place where things go on sale and people run away instead of buying more. When the market falls, you stay calm, stick to your strategy, and keep investing consistently. And slowly, you'll build something most people never achieve: financial resilience. But let's talk about the practical side as well. With $100, you won't retire next year, but you will build habits that allow you to retire comfortably later. Habits like budgeting, saving, tracking your net worth, reviewing your portfolio monthly, adjusting your strategy as you learn. All these become second nature over time. And this is how you go from $100 to $100,000. It starts with the right mindset, multiplied by the right habits, and powered by time. Now we can talk about goals. Why are you investing? What's your vision? Is it to retire early, buy a home, travel the world, help your family? The clearer your goal, the more motivated you'll be to stick with your plan when things get boring or scary. Write down your goal, print it, put it on your wall, let it guide your financial choices. Because investing is not about numbers, it's about freedom. And freedom is built with intention. So don't just throw your 100 into any asset because someone on the internet said it will 10x. Do your research, understand what you're buying, and make every dollar work toward your goal. Next, we'll dive deeper into how to evaluate good investments, what metrics to look at, and how to spot red flags before you lose money.